Welcome to StockMarketFunding.com. What we have here, folks, is that this is a $100 put on Amazon. And the put option was inflated up here at $6, but it's not so inflated down here at $1.20. What that does is that when the equity price had moved up in the last couple of weeks, rally off the bottom, that put option right here went straight down in value. And that gives us a royal opportunity. Because if you're buying puts up here at $6, that's $6,000. If you're buying puts down here at $4 on 10 contracts, well, that's $4,000. Well, if I'm buying 10 contracts down here for $1.10, that's only $1,100. There's a big difference in that mathematical dollar cost risk management trade than being over here, meaning that now it allows me to get on that side of the trade. And that one there, my friend, is the Amazon $100 put option. I'm even going to go to another handle about learning how to trade premium. And what I am going to do is I'm going to pull this particular one up right here. And that's going to be bingo. Now, that happens to be a put option that was at $1.60. It also happens to be an $80 put option that even within its mathematical range, mathematical dollar range, which ultimately can be all of your dollars, is that I'm going to be able to, now Amazon does not have to go to $80, and I didn't say that it would. It's a premium trade in the deflated zone. So what I'm going to do is that my risk over here at $1.60 was quite huge. That's this risk right here at $1.60. So if you bought 10 contracts up here, say you paid $1.40 right here, that was $1,400. Okay, but then again, the SMF, options per specialist, which is an options market maker, understands these trades that all market makers do. I didn't say options day traders. I said market makers that control the pricing mechanism models. And not only do they control the price, they also, by creating the price, then that's when you are able to observe the human behavioral transaction within Wall Street and how they're led into these things. So yeah, I'm going to be led in down here cheaper than anyone else. Now, it doesn't have to drop a lot. It doesn't have to go to the $80 strike price. I never said that. Okay? What I did say was that at the deflated price and the markets continue to go down, there's still an upside premium. So if I buy these for 15 cents on 100 contracts, I've got 100 contracts. Instead of only being able to have 10 contracts here, I've got 100 of them down here. And we make a move back up toward $1, and I'm in at 15 cents. I made 85 cents. I made $8,500 on my $1,500 investment, and that's the reality, whether you like it or not. And that's the kind of things that we do here. And I'm not trying to make you mad about watching the video. What I am trying to really express to you is this is how things are done in our world. And our world is a little bit different than the retail world and the retail traders and the retail day traders. Our world is not any of those worlds. So basically, there's a premium trade there. I'm going to be taking a look at the 120 put in the money, which is right here. 120 put in the money. Okay, stock closed at 118 and some change. Now, when you go look at Amazon weekly and monthly charts in the previous video, you could see why we're bearish on it. But once again, folks, the put options have come from $16 and they're all the way back down here. Last time we were deflated in the put option. This was deflated. And they popped it up to the inflated, and now they've brought it right back down here into the deflated area. Now, we can even go below that deflated area. However, we're going to be measuring it, and this is on a weekly chart. We can see where the buyers moved in. The buyers moved in down here in the 580 range. And basically the retail price, once again, $14, you were buying some protection up here. $10 put, you were buying the puts at 14. And when they ran Amazon up, in price, it dropped the value here to a wholesale price entry. Now, everyone's looking on Amazon to move higher. I can tell you that's the 120 put against the 120 call, which just shot right up here to $10. It was inflated. The call, this range down here was kind of deflated. They popped that thing right up to $10. But look, closed back down at 580, lost all the premium because it's inflated up in here. There's nothing wholesale about buying this call up in here. Not anything. And this is a weekly chart. And they're weekly moves. You can see where they bought that week. And when Amazon was selling off, it made a low. And when Amazon bounced, that call contract went up off of this bottom and continued to go to that high during the options expiration and has come right back down. And the reason why we're looking at the weekly is so that we can see the weekly options expiration. Is what they did was they inflated it and then just started deflating right down. And the reason why it lost all its value is because the stock trend on Amazon is weak. Bottom line. We'll be watching the 125 that's well in the money, that hit $20 a contract, that's coming down here to the deflated area. When you're trading in the money put option, such as this 125, it's $7 in the money. It hit 870 on the low, and that was the trading range, 870 to 1052 for that period on Friday. So basically what you want to know here is that as the put option is deep in the money, but the price got down here to a deflated area, and bam, that 125 put bounced. $20 retail up here, retail here, retail in here, and wholesale down in here, if we can get it. With the current trend structure on the weekly and the monthly charts on Amazon, our weekly sell signals and monthly bear charts, we may have to move in here somewhere, because it's going to move a lot more when it's in the money. And that's the 125 put for August.